Hi, it's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to go through a pretty robust market update. Start with the S&P 500, look at some other key indices and ETFs, crypto, and also review a recent trade ideas which we provided for our clients just this morning. So let's begin by looking at 2025 versus 2020 because there's been more than a few comparisons to both years. As we know, S&P has done a very good job coming roaring back from the April crash low here, up about 34% using intraday high and low data. If we go back to 2020, we can see that from the low, of course, after the COVID crash to right around the late August, early September high, S&P was up 63%. The reason why we have this area highlighted is because it wasn't too far before that the S&P actually made a new high versus the previous high in 2020. Of course, recently it did so a number of weeks ago already. So in terms of how much it's up, obviously not as much as the index was back in 2020 at that time, but it's already overtaken the previous high. So not exactly apples to apples, but very close. What's most interesting about it, of course, is after it did so, and after really the summer months ended, that's when we saw the first correction. In fact, two corrections. Right? It's maybe difficult to see here, but anyone who was around during that time remembers that we had 10% pullback in September, very quick rally right near the highs, and another 10% pullback once more. And so remember, at that time, we were still in the middle of COVID. Everything was closed down. There was a lot of fear about what was going to happen in the world, number one, financial markets, the economy, so forth and so on. So seeing those two 10% back-to-back corrections wasn't the easiest thing to sit through. And not forget as well, right here in June, the S&P was almost down 9% as well, including that one really big down day of 5.9% on June 11th. Now that compares to right now, where the biggest drawdown has only been 3.5% from a high, which happened twice in May and just, again, a few weeks ago. So as we come to the end of the summer, as we're getting close to, of course, the new business new year, as I call, after Labor Day, we just have to be prepared for at any point for a downturn to come. Now, as viewers know, the crux of our analysis is looking at the patterns. So the patterns themselves are not going to pinpoint the absolute topping point or bottom for that matter, but we'll also see things changing when those patterns start to morph as well, meaning that bullish patterns have been taken advantage of, which we'll talk about a little bit later, and bearish patterns have been failing. When that starts to change, then we know the momentum could be shifting and character change could be afoot. And that's when things can really start to look different. That has not happened just yet. So one of the reasons is that for the last 8 weeks, things have been just extremely quiet. This is going back to June 13th. That was a 1% decline. After that point, though, things have been really one-sided. Now, as you recall, we had the big negative reversal right after the last Fed meeting to end July, which then led to the pretty big 1.6% decline to start August. And as we know, seasonality for August, subpar, and there are a lot of people, both bulls and bears, talking about it as August began. But as we know, that was just another dip that buyers gobbled up, which led us to getting to new all-time highs again over the last few days. Now, looking at this more closely, a few things stand out. Number one, over that time, there's been 44 trading days. 25 times we were up, so about 57% of the time. That means that 19 losses equates to 43% of the time of having a decline. So that may not sound too lopsided, but if you look even more closely into this data that Stockcharts has, you know, the average gain 57 basis points, average loss 33, so just about double. That's pretty severe. Number of 1% gains, again, since after that June 13th, 4 of them. Number of 1% losses, just 1, just that one we just talked about back on August 1st. Of the 25 gains that we've had, 9 of them have been 40% or less. So just 36% of the time. So in other words, a very small percentage of the gains have been small, 40 basis points or less. But of the 19 losses, 16 so far through Monday, August 18th, have been 40 basis points or less, or 84% of the time. which is just a huge amount of tiny losses. And what's good about tiny losses? Well, we know that, to say as the saying goes, never short a dull market, but more specifically, when you have small losses like that, it just means that volatility is less, and typically have low two-way volatility, which means the number of 1% advances isn't a lot as well. We just have 4 of them, but again, over an 8-week period, that's not a lot at all. And all of those are key characteristics of how bullish patterns can form, be taken advantage of, and of course, all that leads to the type of uptrend that we've seen. So again, that's in the past, but at the same time, many people have been doubting that this could continue up to this point, and it has been. So we have to recognize currently what we're at, understand that there's risk always involved, and eventually we'll see all this reflected in, again, how these patterns are dealt with going forward. So zooming out a bit, looking at the weekly Bollinger Bands, and I believe we touched on this chart before here, and this has been very, very telling going back at least to 2017, where all of the best uptrends, the longest, most consistent runs we've seen, all had one key characteristic, and that was that the S&P 500 routinely hit the upper band of the weekly Bollinger Bands over and over again until there was a shift. We saw in 2017 basically the entire year. At the end of 2019, mostly the whole time after the comeback from COVID through the end of 2021, once more started to see it at the end of 2023 into 2024. And so far, even though we've compared this comeback to both 2023 and 24 and 21, this is one thing that has yet to happen. I haven't seen the S&P get back up to the upper band. And one of the reasons is that we're coming off such a very strong volatility event. Those bands widened, almost historically so, as we can tell here. And so eventually those bands will come down as the market slows down, and the S&P will then hit it once more. So it's a matter of if and when that happens, and when it does, how long can the S&P 500 hang near that upper band? If it does, we have plenty of examples to show us that we could expect a much more in the way of an advancing market going forward. If it fails after touching it the first time and then obviously drops back down, then we would have to question the longevity of this advance. So turning to the GoNoGo charts, which have been extremely helpful since we've been really using them over the last few months. This is an updated version through Monday, August 18th. And as we can tell, number one, we've continued to be in a bullish trend, which started from this perspective in the middle of May. So one of the things I want to talk about is these red triangles, which just signify a counter trend move, or really shows that a market that has come off an extreme level and is pulling back. Now that, of course, can mean just a pause, like we've seen recently. Nothing really affected the uptrend, or it can lead to a much bigger downturn like we saw from late January, which eventually led to the market falling apart, or at least marked the beginning of a trend change there, right? We remember at the time that lined up with seeing bullish patterns fail. So bullish patterns aren't failing yet. If and when they do, then these could work. If they continue to work, then that means that it could resemble something like we saw from the end of 2023 all the way through 2024 for the most part, where the uptrend was characterized by having the S&P just kind of ebb and flow its way along, making new highs, which is characterized, again, by these short-term pullbacks. And if you think about it, this is really what a lot of indicators show when the S&P 500 is, any index is in an uptrend. From our side perspective, for instance, we know that it gets to overbought territory. It doesn't stay there that long, but when it pulls back, many times will respect the midpoint of that range. It just shows that momentum ebbs and flows as well, but eventually buyers come back before there's much damage done to the system. That's how then we see more bullish patterns take shape, more breakouts happen, so forth and so on. So needless to say, from a weekly perspective, the GoNoGo trend remains higher as well. We are now on week number 9 of this being in a bullish trend as well. We've shown this in the past, going back all the way to the biggest turns and the ensuing rallies since 2009. All of them look very similar to this, when we've seen the weekly GoNoGo trend get back to bullish near previous highs. So not near the lows, but near the highs, but then kickstarting a much bigger longer uptrend, right? And this is the same type of track that the S&P continues to replicate. So let's take a look at the pattern work first. But before we do so, I'm excited to introduce Cap Notes, our free Substack newsletter, where we provide timely market commentary, trade ideas, and access to select premium content. Sign up today and receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Simply go to capnotes.substack.com, hit subscribe, and we'll send that guide directly to your inbox. Okay, so we start every pattern section of our premium pieces at Gap Thesis with this pattern grid. We've shown this before as well, but this really keeps us on the right side of the trend because if there's a pattern that's going to be live, it's going to appear here. We track each one of them, both bullish and bearish, as long as we have either a breakout or a breakdown. So coming into this week and through this past Monday, we have 3 bullish patterns still in play. But the most recent one happening on August 12th, only about 60 basis points above that breakout zone, again, starting on Tuesday morning. So this one is at risk. And really that's the same with every initial breakout. Tentative until proven otherwise. I mean, you see how these look here, starting with the one that's closest. And this was a breakout again from May 12th, 65.55. And as we can tell, that breakout zone wasn't even tested. And we've had that staircase-like advance all the way through. There's one particular feature that I've started to use much more, and that's just being able to display zones like this. And this isn't exactly support and resistance. It's just my way of identifying where the danger zone is for the S&P 500 or anything for that matter after a breakout. Where if it's anywhere near this green zone, that means it's at risk of undercutting the breakout zone. If it's above this breakout area, this target will remain in play, and the S&P has the ability to back and fill along the way. And again, this only happened once, so this didn't really come into play. But if it did, and then undercut this breakout zone here, then we know that this entire potential upside objective would be at risk of failing. And I didn't really even know this existed until I saw Dave Keller talk about it in a video a few months ago. So all you have to do is go into the annotate section of the chart, pick rectangle, pick the shaded rectangle, choose your color, and then you can control the opacity from completely solid to almost hollow. And moving lower on that opacity gauge just gives you the ability to see the price actually enter this without it being shaded. So just an artistic feature that I find very useful, especially since I write and talk about this all the time. And so the most recent one, of course, happened on a 2-hour chart here. And this actually could come into play much more as the market pulls back here on Tuesday afternoon. And so we could come into the next day or the day before with this, again, most recent breakout with a 66.05 target negated, right? And that could very well happen. And if that starts to happen more from the bigger ones, then we know that, again, the market's character could be changing, but for now that remains in place. And then right away, the breakout that we saw that produced a 67.45 target was tested, it held, and off we went. So the bigger targets still have a lot of leeway. And so even if this smaller pattern that we just talked about failed, another one could develop and then be leveraged in a better way. But until that happens, we're always tracking the potential bearish patterns as well. Now, we talked about how numerous times they've already failed so far in 2025 since the April low, but new ones could form at any point. And the most recent one that we're looking at is using the most recent high as a potential head of this bearish topping formation, or more particularly, something that could develop into head and shoulders pattern. If we do see downside follow through, a failed bounce, which produces a lower high, and then a breakdown. So these are all a few steps ahead, but as you know, these can happen pretty quickly, especially if the market continues to sell off, and then you see volatility on both sides, both on the downside and upside, and that's what can produce this right shoulder, which is something we'll be tracking going forward. Now, moving outside of the index into some sectors, healthcare has been in the news recently because it led last week for the first time in quite some time. Look at the XLV ETF. And we know about this, a lot of head fakes along the way, especially over the last few months. Now, it continues to be off of its lows, but it's really been about traders buying weakness and selling strength. And with last week's rally taking you right back up to resistance near 138, the onus is still on the bulls to do something much more significant, meaning buying on the highs or buying strength as opposed to selling it. And so, again, it's been frustrating because everything else has been making new highs or thereabouts, where healthcare hasn't. But we're taking this one step at a time, meaning that at least we haven't seen an oversold reading since the lows. And along the way, there's been a slight, ever so slight, positive divergence in momentum looking at the RSI. So from this perspective, still in a downtrend, still trying to get through resistance, and looking at the RSI, finally getting back to overbought territory again is going to be necessary for this tide to have any chance of turning going forward. Now, from a very long-term point of view, it actually looks even more interesting because if we draw a line from the 2009 low, which connects the 2020 COVID low, and then the most recent low point from this past spring and summer, it means that XLV has a real chance once more to rally after a big downturn like it has two prior times going back, again, 16 years now. And that somewhat coincides with the support levels that we saw from 2021, 22, and 23. So there is a confluence of very long-term support here. So it's not always about buying breakouts on short-term charts. Sometimes technical analysis is just as useful as identifying just the most significant long-term reference points to add to your long-term positions or to start a new one for that matter. This is going to be an important one to watch going forward as well. So on the other side of the coin, right, with healthcare is biotech, which of course is much more volatile. XBI in particular. And this one has been doing a pretty good job so far of coming back. It hasn't been a straight shot higher, but we had the breakout of this bullish cup and handle pattern at the same time as the downtrend line from the November highs of 2024 was being broken. And that produced these two trading boxes with so far we've had two straight trading box breakouts. The first one we had a little bit of follow through, but for the most part, it was more important to see the ensuing digestive phase holding the upper half of this previous box. And now with the XBI pulling back again on Tuesday, it will be important to see the same thing. It just means that we're seeing higher highs and higher lows. But we know the XBI as well has a lot more ground to make up. And talk about selling into strength and buying weakness. This has really been the name of the game going back all the way to 2022. And again, showing this in terms of the colors we can use from the system really hammers the point home. We're getting very close to the mid-90s. We eventually see buyers continue to step in here and eventually push this through 105 because that has been the obvious stopping point for all of these rallies. And it would be a huge change of character if number one, we eventually get back up to that point and that area finally gets leveraged to the upside. So looking at the TAN Solar ETF has been on a huge run as well, up more than 60% from the low to the point where it's now sitting very far above its key weekly moving averages, but with those weekly moving averages finally starting to turn higher. I mean, all along the way, we showed how many times that these pretty substantial short-term rallies all failed, either right below the cluster of lines here or right above them. And not surprisingly, looking at the 14-week RSI, each of those times also failed to get much back above the midpoint zone. So all that together just tells us we're in a long-term downtrend. Something really drastic needed to happen in terms of a bounce for that to change. And so far, that has been happening now, which has become much more prevalent over the last few weeks. And so from this perspective, it'll be important to see this eventually get back to overbought territory because the last time that had occurred was back in 2020, early 2021, when finally, as we can tell here, right in the middle of the summer of 2020, finally hit overbought territory and got pretty extreme into the mid-70s and stayed there all the way through the end of that run, right? And so we're not suggesting that this is going to be repeated, but at the same time, it is closest to resembling what happened during that stage than at any point before this over the last number of years. So one area that has obviously not done much recently is gold. And we can see that here. Now, this is a weekly chart in log scale. And so while there's been a lot of people doubting that this breakout could occur because of all the clamoring to get into risky assets over the last few months. If I'm just looking at this with blinders on and not caring what this is an extremely attractive bullish pattern, right? You're percolating near the highs for the last few months. We can look at this as a potential inverse head and shoulders pattern or an ascending triangle. In fact, we can look back going back to the action since 2023. This could be the fourth such bullish ascending triangle pattern, with obviously breakouts and then extensions happening the last few times. And it'll be interesting if this occurs relatively soon, because down here we can see the gold versus the S&P 500 on a relative basis has come in. The relative line has come in a good amount, as we expect, and right back down to support that we saw from 2023. And that coincides with, again, the area that I broke out from on an absolute basis. So let's not completely forget about gold, because it looks very interesting, again, from a mean reverting perspective versus the S&P 500, and from an absolute perspective in terms of a potential breakout to new all-time highs. So Bitcoin, as we know, has come under pressure recently. And so looking at, number one, what this has done to the big breakout, the 142,000 level still remains in play. And it's getting close to its former highs, where it hit about 112, 113 in the middle of May. But really, the way we're looking at this in terms of the breakout zone, closer to 109 here. So it is entering a danger zone, right? As we show over the S&P 500 in green here, not quite underneath the spot where it broke out from, though. So again, this 109 level is going to be critical over the next few days and to a few weeks, of course. Now, from a daily perspective, we can see that all of this has turned the last number of weeks into a potential topping pattern, a double top here. Now, we've seen this before. We've seen a double top potential fail as the year began. We saw another one then develop as 2025 progressed in the last few months, turned into one huge rounding top, which we finally got the breakdown to. Didn't quite get to 72,900, but we did get a good amount of follow through as S&P 500 and so many other things were falling apart at the same time. Now, from that point, got the rally, and the ensuing double top was extremely short-lived. We got one particular day, we had that breakdown at the end of June, which then slingshot Bitcoin through new highs and, of course, hitting the 120s. So this is going to be very important to watch, because over the last few months from the April low, the best buying opportunities in Bitcoin has come after these short-term pullbacks have put the RSI near the low 40s, which it is once more again now. And lastly, it's important to note, even if we don't care about Bitcoin, because it topped out before the S&P 500 did, and to start the year, and potentially could be doing the same now, where both the S&P and Bitcoin made new highs just a few days ago. But of course, the pullback from those highs has been much more severe with Bitcoin up to this point. Okay, so lastly, a recent trade idea is Uber. And so again, talking about bearish patterns failing has always been a key characteristic for an uptrend. And that is exactly what happened now over the last number of months. We saw it happen in May. We could actually make this one or other mini bearish pattern, which didn't work out. The ensuing rally then produced the third potential bearish pattern. And we did get that downside break here, but only momentarily. And that then produced the next rally through, again, this past Monday. And if we look at that from a bullish perspective, we can tell that that now has been constructed into a small but pretty identifiable potential inverse head and shoulders pattern, which would have an upside target near 103. And Uber is an important one to watch, right? It's not one of the biggest, but Uber is special for numerous reasons. It's a growth stock. It's classified as a software company, but we know it could also be consumer discretionary based on how often people want to order food or take a quote unquote premium trip in a car. And for that matter, it can be considered transportation as well. So seeing how this potential bullish pattern now works out will be interesting going forward. And from a go-no-go perspective, recently trying to leverage this recent go trigger in the last two times that happened, right? Coming out of 2025, big rally. And then after the April downturn, and once more, we had weeks of follow through there too. And lastly, on the weekly chart, we know it continues to be in a strong uptrend, and this whole thing is taking place above the most recent, much bigger bottom information and ensuing breakout. That's what we have for today. Thanks again, and I'll talk to you again soon.